Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of June 29th, 2025. And in this week's episode, it's just myself, Sprocket888, and I'm going to take a look at once you have played an earnings trade, what do you do next? How do you close that earnings trade out? Due to the timing of the recording of this episode, I thought we might actually get to take a live look at what it looks like to close on a live market. However, there are some extenuating circumstances that will not have me closing out my trade live, but we're still going to talk through and look live at the trade and talk about why I will not be closing this trade out live today, as it is expiration day of this earnings trade while we record this. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you can find a link to thetagain.com/sprocket888, as well as /ViperXL007, where Viper and I post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. So in this week, I actually played two different earnings trades, one on FedEx and one on Nike. FedEx was a strangle, and I went ahead and actually closed that out the day after the earnings announcement. Turned out to be a really big winner, about a 97% return on the premium that I collected. And then the second trade was Nike. Now, Nike was going to announce, and then today, the day of this recording, I was planning on closing out the trade live. However, the market and the earnings results were just absolutely spectacular with Nike, and the stock went off to the races. I'm going to show you the live option chain and show you why I will not be closing this trade today, which is contrary to most of my trades. A lot of times I will close out the day after earnings, particularly once a large percentage of that premium has been collected. 50% is my threshold, but I will kind of push it up into the 60 to 70% return in many times. However, on Nike, we are currently sitting at like 100%, and the market is still open, and I'll show you why in the option chain in just a second. Before we take a look at that live option chain, let's take a refresher on how we got here. So every week, I typically do a screening over the weekend for earnings trades that are coming up. Basically, these are companies that are announcing earnings that particular week, and I will sell options before. Typically, I will open up all the options no matter when the earnings are on that Monday. I will sell the options, and I will make them for the expiration of that Friday. And what I'm looking for when I go to sell those is any sort of company that has earnings where the volatility is elevated relative to where that volatility normally is. So what I'm looking for when I go to sell that volatility is I look back over the past year as far as what's the range that volatility has resided in. And if the current volatility is in the upper half of where that trade has been, or where that underlying has been an actual volatility in the past year, that's considered basically about a 50% or higher implied volatility, not the raw spot volatility number of the option chain, but just relative to its range over the past year. And then I will give a little bit more preference to things that have a higher spot volatility. Now, right now, there's really not earnings season going on, so you only get like onesie, twosie companies each week. This particular week, there was really only two that hit my screener, FedEx and Nike, and I wanted to talk about Nike here first. Because Nike was the trade that happened most recently. You can check out thetagain.com/sprocket888 to see actually how the FedEx trade worked out. It worked out very nicely, beautiful volatility contraction. And so what did we see when I went after Nike? So going into earnings, let's take a look at some of the charts and the price action. And so what I've got here pulled up on the screen is this red box is the put that I put on for Nike. And the day that I put it on was Monday, the week of earnings. And then this expiration is the end of the week, and that is where the options would expire. This big candle is the earnings trade, and you can see that it stayed well above my strike and just kind of rocketed up. Now, because I was only playing this on the put side, this was like a 35 delta, so this was a little bit closer than I normally would play earnings. But because I was only putting on one side, that's where I'm going to go ahead and tilt that a little bit more of the delta. So when I'm playing both sides, right, I'm going to go with typically a 16 to 20 delta, because you have to stay below the call, and you have to stay above the put. So you kind of combine those two probabilities, and you're really looking at around a 40 delta. When you think of probability, you have to combine that, so you have 60% chance of winning, 65%, depending on whatever you combine those two numbers to be. But because I'm only going in one direction here, I can go ahead and pull that up and collect more premium. And since I was bullish on this trade, I was, that's perfectly fine. So why was I bullish? You really can't tell looking at this zoomed in. These are 15-minute candles, so you can see the granularity of each and every day and really get that nice move in earnings. So that's why I have it pulled down like this. But if we take a look and we zoom out on, what the heck was going on a much, much higher time frame, this right here is weekly candles. And so these lines here are actually rectangles from other earnings trades. They're not actually wicks. I know they might look like wicks, so let me take them off the chart here. So this is going back years. 10 years is going back to 2016, and where has Nike historically traded. And so if we kind of go back, we really weren't back here at these levels until way back here in 2018. Where we were kind of below. And so what gave me confidence down here in this, 50s range is there's a lot of support here. There's kind of, this whole range, and then we took off to the races, got all up to 175. This right here is the big COVID drop, where we, hit a low of, $60. Now, Nike was trading below where it was on COVID. And so when I look at all of these data points combined, there's no guarantee that things are going to go up or things are going to go down. Nothing's promised. But when I look at a chart at such a wide time frame, I think to myself, hey, there's a whole lot more risk to the upside than there is to the downside. Means there is a lot more room to run on the upside than there is on the downside. Because this is a historically a level that there's been a lot of price action around, and Nike has changed a lot in 10 years. So you could say, well, it could go a whole lot lower. But anyway, this is one of the things that played into my confidence that said, hey, down at this level, I don't really want to get on the upper side of the Nike move. I want to stay below the Nike move and play it a little bit more bullish. Especially when you get a lot of pent-up volatility and you have something like this where you're really coming up against a lot of historical level there, you probably could rocket up to the upside, and I didn't really want to be short the call. And that's why I chose to really only play the put side. And sure enough, that really panned out for me. When you take a look at, where did everything go? This is it. And sure enough, we went up. And so that was really a lot of the background into what was driving my put side play only on this, and why I felt good about the probabilistic outcome of a move in my favor. And lastly, whenever you play a naked option like this, you have to be okay with assignment. And to be honest, buying Nike at 58, given this longer term chart and where it looks like over time, that factored into it. Like, hey, is it really so bad to own Nike at 58 relative to the price action of this chart and where it has been? And the answer for me was no, it's not too bad to own it at 58. And so that really just kind of solidified the direction that I wanted to go with this, to play it as a put-only selling option trade. So the next thing I want to show you is basically the volatility contraction on Nike. So what I've got here on the chart is basically this white line, this solid white line is the actual implied volatility of Nike leading up to earnings. This more faded line, which you might not be able to see so well, this is the price of Nike. So this axis over here on the left is the price of Nike. This axis here on the right is the implied volatility. And so just before earnings, when I sold this earlier in the week, we were up here in the 48%, 49% spot volatility. And then what happened is earnings kind of came out, price spikes up here to the $73 mark, but notice cliff that this white line just drops off of. I mean, massive contraction and volatility. And so there's several things working in my favor, which is one of the reasons I sell options here. Volatility contracting, right? So when I sold this option, I sold the volatility. The volatility increased the premium. There's time left in the option. Basically what is happening here is the volatility is contracting, which is dropping the price away. Time is almost out of expiration, so time has decayed away. And this is also moved in my favor. So, three things were going in my wind blowing in my direction, if you would. And so what this has done, if I slide the option chain over here, has created a situation where it's really not feasible for me to close out this particular option. And what I mean by that, if you look here at the option chain that I've dug over, we got expiring on June 27th. That is today, the day that I'm recording this. This is the option chain come down to this strike of 58. Here is the bid and the ask. There are no bids. So nobody is trading this option. Why is nobody trading this option? Because selling a put or buying a put, the likelihood of this thing dropping from $72 to below 58, like nobody wants that trade. So to put this in, to buy back my options to close, basically there's a 1 cent ask out there, but nobody is really picking up on a lot of these things. So one, you're gonna pay commission on each of the options to close this. Two, you're probably going to have to, find somebody to buy it. So this is a particular example of it doesn't make sense to actually close. But to show you what a more active chain would look like, fast forward, it's basically July's expiration options. Now, I'm not trading these, but I just want to show you a live option chain here of what it kind of looks like. So this is the July 18th expiration, just 20 days away. And what we see here is a bid and ask spread that's relatively tight, kind of showing good liquidity on this option mark. So $70 option here is bid is 91 cents, ask is 97. That's about a 6 cent delta. For an option chain, that's pretty good. A lot of times in the option chain, I consider anything a nickel or less as very, very good. And then the spread, I'll go as high as 10 cents or so, depending on the underlying. And so you can see as time goes by, this is not going to change. And this is what it would be trading at if you want to go make a trade. But like I said, going through this particular trading day, yes, the options down here at 58, there's no bid and ask. But if we actually come up closer to the money, you can see decent options volume and option trading occurring right here at the money, which makes sense, right? Because these options expire today. So the likelihood of moving away from where those are likely to be, you can see how quickly this delta drops off. I mean, you come down $1 and you go from a 40 delta to an 18 delta. So you move out just $1 and your delta gets cut off. If you contrast that to the July 18 mark, if you come down $1 here from 72 to 71, your delta just goes from 38 to 31. And that really speaks to how steep that curve of delta becomes the closer you get to expiration. So the mountain of delta will kind of start peaking and get tighter and tighter, which is why the premiums out of the money fall off so quickly as you get towards expiration. It's an exponential decay. So where does that leave me with Nike? It basically is going to leave me with 100% winner. So I sold those 58 puts for $1.44 a contract. I sold 7 contracts. So you can multiply $1.44 represents 100 shares. So that's $144 a contract. I sold 7 of those contracts. Right now, to close them out would be a penny or so if I was to find a buyer. However, they do expire at the market close, and they will expire worthless. And so what I will do is let that clock run out and just let it expire worthless. The benefit of that is I won't have to play any closing costs or fees to close those out, as they just kind of disappear and get written off as expiring worthless in your brokerage account. Now, when might I not want to do that? And so one of the things I might not want to do that on is if we were a lot closer to the money, right? If there was a probability or something that looked like we could dip below, I would not want to take that. So I would either roll it forward, depending if we were in the money, or I might close it out and just pay to close. So for example, let's say that we didn't actually move huge. Let's say that, maybe Nike went up marginally to $62, $63. It was a day of expiration and a 58 put. I might have to pay 10 cents, 11 cents, 15 cents to close those options. And I would do that because in that scenario, I would be kind of leaving $15 on the table, like risking all of the money that I had gotten the decay out of in the chance that the price might just drop below that strike and go in the money And so there's no reason to leave that much risk on the table. So you've already can pocket the difference between $1.44 and say 14 cents. And so why not pocket that profit right then and there? Why leave all of that risk on the table for an extra $14, for an extra $15, whatever it costs to close? And that's really that trade-off. And so earlier in the week, I told you that FedEx, I had played FedEx earnings. And FedEx was a strangle, and it really almost didn't move. It was like, hey, diddle diddle, right down the middle. It was an amazing strangle as far as where the price kind of went. But they reported earnings very early in the week, and so they had the whole balance of the week. And the volatility that had come off of that had let me collect 95% of my premium. And so to me, there was very little value, or the risk to reward was not in my comfort zone of saying, hey, I'm going to leave this strangle on for an additional 3 days to get 5% more of the premium that I had collected. To me, it wasn't worth it. I would rather close that out, pocket the 95% of the premium that was guaranteed to me based on where the FedEx started opening on the next day. Who knows if it was going to rally, if it was going to drop. The odds were that it wasn't, and I probably could have let that ride all the way into expiration and get 100% of it back. But that's 3 days of uncertainty. Now, why is Nike okay to leave on? Well, because one, it's just the balance of today as far as uncertainty. Two, it is significantly out of the money, like very, very far. And so to me, that risk reward of, trying to find a buyer to buy those options, I just don't want to do that. So I'll let the expire worthless. Yep. That brings us to the end of this week's episode. A little bit of a look as far as what goes through my consideration when my earnings trades are up. How do I close them? What does it look like when I go to close them? What are some of the factors that get played in? And this is all, your mileage may vary. What's comfortable to you? Maybe you are not comfortable leaving that risk on when it comes to Nike, and you would go chase down a buyer to try to get those puts bought away from you to close out. And that's perfectly fine. That's within your risk tolerance, and that's what makes the move. Maybe you are the type of person that would leave that FedEx trade on for the balance of the week to milk out that last little bit of premium. And that's fine. It's all about where your risk tolerance comfort is in the risk to reward ratio. And it just goes to show that, you don't always need to close out your trades right after earnings. Sometimes there are cases where you can let it go into expiration and expire absolutely worthless. The real benefit, in my opinion, of that is you don't have to try to find a buyer and get a bad fill if there's not a lot trading. Two, you also don't have to pay the closing commissions. So it's not a lot, but it's not zero. And so, when you're talking about a few pennies or something like that on a closing commission, every little bit helps. So if you don't really need to put that out there, then you don't have to. Now, there's not a whole lot more earnings. We're kind of in a lull of earnings season to about a few weeks away from a pickup of the next quarter's earnings season, where there will be a lot more of these trades kind of coming in. The market has been on an absolute tear lately, so volatility is not that high in a lot of the traditional underlyings that I like to trade. So there's not a whole lot of trades out there that I'm actively ready to jump on and pounce, but I do imagine some of those opening up soon as earnings are coming up, and inevitably market volatility shall return at some point. I don't know when, because we seem to be back onto the up and to the right trajectory, but we're approaching all-time highs, and every time we kind of push into all-time highs, you can kind of get a little bit of a gut check when it comes to that. So it's possible that we might get a little bit of market turmoil, market volatility. I will welcome that very much, as it will help drive up the premium that I like to sell. Otherwise, hopefully you can find things that you like to trade out there as far as your strategy is concerned. Good luck, have fun, and remember, think outside the block.